Okay, so now let's get into our model. There are 4 tabs in here. The main model is the LBO tab. Shares outstanding is where we have, we're going to calculate the actual diluted share count. The DCF model, we're going to get into later on. It's going to help us arrive at a valuation. Remember, this deal is getting done for $46.25 a share. Well, does that make sense? And how does that contrast to an intrinsic valuation? Those of you who've gone through our DCF course, this is going to be a very familiar exercise, sort of a side exercise to the core LBO exercise. Last but not least, we've also included a 52-week chart, which identifies the closing share price every day in the year leading up to this deal. And as you'll see, the deal was announced, the volume was through the roof. The deal was announced on a Monday. The Friday before is $45. It closed at $45.42. So that's the model. So let's just get started. So first, let's put in the current share price. And now we're going to put ourselves in the position of modeling this deal before it's announced, like moments before it's announced, because we have all the information about what actually happened, which is going to make this a much more colorful exercise. But let's do this from the perspective of, hey, the deal hasn't happened yet. Let's see what it would look like. It's May 6th. The deal is about to happen. We have timely information. Let's see what that looks like. 45.42. This is the closing price prior to the deal. Share price date 5/6/2013. Circuit breaker. So this is something that those of you who have taken our classes before are quite familiar with. There's going to be a circularity in our model. The way that our model calculates interest expense is going to in turn create a circularity. We're going to talk a little bit about that when we get to the debt schedule. Probably be a review for most of you. We want a toggle in here, Alt-DL for data validation. Again, that's sitting in the data validation for those who want to know where it's sitting. And you want to allow list. I want in here 2 options, on and off. Now you have a little drop down, Alt down arrow key to select on or off. Okay. By default, it should be set to off. We haven't tied it or connected it to anything right now. It's just a simple static dropdown that has these 2 data pieces in it. We'll talk about why we need that later on. Let's move on to the selected financial data. So a few things here. First of all, EBITDA on an LTM basis. This is, since we're going to be talking in terms of EBITDA multiples, one of the first things we're going to need to play around with is what EBITDA actually is over the last 12 months. Let's, for the moment, just hard code 880 million. It's actually very close to 880 million in reality. We're going to do the heavy lifting of actually going through the historical filings and calculating LTM EBITDA in just a moment. For now, just hard code 880 because I want to get through a couple of assumptions before we do the heavy lifting of actually finding in the source filings. I also want gross debt and cash for the purposes of calculating net debt. One of the things that we're going to see fairly quickly is once we define the deal in terms of its enterprise value, we want to figure out what the equity or offer value should be. So we need to subtract net debt. Okay. So let's find gross debt. Include in your filings, I've included the 10K that came out the day that the LBO was announced. So May 6th, the same day that the LBO was announced, they also filed a 10K. All right, May 6, 2013. I'm going to scroll down to the financial statements, which are on page 46. Let's get back up to the balance sheet. And here you see a balance sheet with long-term debt. Here we are, assets, liabilities. The only debt this company has is a tranche, $1.3 billion. Had it had any non-controlling interest, preferred stock, anything that's considered a debt equivalent for the purposes of calculating net debt, I would have wanted as well. They don't have any. They just have this $1.3 billion long-term borrowing. Let's actually put this as a minus just for the purposes of calculating net debt. You're going to see why. It doesn't matter as long as we're consistent about the calculations. I wanted net debt as a negative. In fact, so let's be clear about that. Put as a negative. And then cash, I actually want as a positive, and I want cash and equivalents. All right. And beyond that, I also want short-term investments and really any long-term investments that are effectively can be converted to cash fairly easily. This company has a whole bunch of short-term investments, and even their long-term investments you can look in the footnotes and you can sort of see that these are the difference between long-term investment and a short-term investment is, imagine a company decides to buy some mutual funds or government securities, and if they intend to hold them for the long term, they actually have to recognize them as a long-term investment, but they certainly are liquid and they can certainly be converted into cash fairly quickly. And so I want to make sure that we've got all of that. Oh. All right. It didn't like that there was a comma in the 1379.2, so correct me. All right, so now I have their cash and their gross debt. Notice they actually have a negative net debt position. In other words, their cash is greater than their gross debt. Minimum cash desired and EV to LTM EBITDA multiple at exit. Let's hold off on that for a second. There's a little bit of work that we still need to do before we can talk about that. Now let's turn to initial valuation.